QuickBooks Pro Desktop 2021. Forward contract for speculation that foreign currencies will weaken maturity transactions with the help and use of Excel. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in the problem 3, multiple currencies. We have the open windows open. You could open the open windows by going to the view dropdown, selecting the open windows list. We entered a forward contract in prior presentations and an adjusting entry at the end of the year. Let's take a look at that now by going to the reports dropdown, company and financial. Take a look at that balance sheet standard, the standard balance sheet, customizing the dates up top in the customized reports and changing them from 01/01/21 to 12/31/21. And then, okay. So we put this on the books where the receivable was held in US dollars. The thing that's going to be changing is going to be the payable, which we're going to be paying 5,000 pesos in Mexican currency in the future. If I double click on that, then we put it on the books at the forward rate at that point in time that we started the contract, that I believe was 180 days. That will end when it will end in 180 days. Then at the end of the year, we needed to do an adjusting entry to adjust for the current forward-looking rate at that point in time. So the $200 there, we also resulted in $200 then on the income statement, and we currently have that $3,900. Closing this back out, looking at the P&L profit and loss by going to the reports dropdown, company and financial, profit and loss, P&L, income statement, changing dates from 01/01/21 to 12/31/21. We see the 200 then here for the loss in the first year. Now we're thinking about the termination or close of the contract. And to do that, let's first consider it in Excel, and then we'll think about how to do it in QuickBooks. So if we go on over to Excel, we're in the same location here, same kind of scenario. We put the forward exchange contract on the books, and we increased the receivable and the payable. The payable then is in the foreign currency, receivable in the US dollar. We then made our adjustment of the $200 for the end of the year. This first trial balance is for year 1, where we have the $200 of a loss reported in year 1. We're then taking the ending numbers here, those being our beginning numbers here in year 2, balance sheet numbers being the same until you get to equity, because the whole equity or income statement rolled into equity. Therefore, equity includes the $200, which is the 99.8 here. So we have the 99.8 down here. So now we're on year 2, thinking about the activity in year 2. Year 2, we're going to say that the contract expires 180 days will end on 4/1, which means that we need to terminate. We'll get the receivable and then we'll pay the payable. So we're going to get the receivable at that point in time in dollars. So we're going to be receiving dollars for the receivable. Pretty straightforward transaction. The payable, however, we're going to have to value once again in terms of the foreign currency. So we're going to have to do an adjustment on the payable to put it into the current currency or the current exchange using now the spot rate, because we're at the point in time at the end. We're not speculating forward anymore. And then we can pay the payable and the pesos using the correct rate. So the first thing let's do is let's revalue our payable using the current rate, which will be the spot rate. So it's been 180 days. It's time for this, the end of the contract, and we have the 5,000 pesos that need to be paid. We need to value them at the current point. That means we're going to actually use the spot rate this time, not a forward rate, because we're at this point in time. We're not looking forward anymore. We've been looking forward to this time, to this spot. We are at this spot now, therefore using the spot rate. So 5,000 times the spot rate of 0.77 is going to be that 3,850. What we currently have on the books for the payable is the 39. So if I subtract minus the 3900, we have a $50 amount that we have to decrease to the accounts payable. So that means the payable is going to be on the bottom. I'm sorry, it's on the top. We'll have the payable on the top because we're going to decrease it, and it's a credit balance. So we'll pick that up, and then the other side is going to be, in this case, a gain. So now we're going to have a gain. And why do we have a gain? Well, if we consider this, last time we were at one peso can get $0.78, and now 1 peso can get $0.77. So 1 peso can now get less dollars. That means the peso has weakened in comparison to the dollar, we're going to actually be paying in pesos in our case. And so we would like to be paying the 5,000 pesos to have a lesser value than they did when we originally started the contract. And so that means the fact that the peso went down compared to the dollar in this case would mean that it was a beneficial thing to us because we're going to be paying at the end of the contract in the pesos. So to do that calculation again, this will be equal to brackets. We're going to take the larger of the two exchange rates that we've last used. This minus this, close up the brackets, multiply that times the 5,000. And that's going to be that $50 once again. So that's going to be the debit and the credit. Let's go ahead and record this out. So I'm going to say, all right, this item here needs to be debited by the $50. And then we've got a loss down here on the foreign currency. Actually, we have a gain on the foreign currency, I should say, because that would be the correct thing to say. I want to say the correct thing, so that's what I should say. So there it is, and now we have that. And so then we're at the 3,850, which once again would be calculated as the 5,000 times the 0.77, and that's the 3,850. So that looks good. Now, the other thing that we're going to need is because we're going to be paying in the foreign currency here. I'm going to make this a little smaller so we don't have to scroll around quite so much. We're going to be paying in the foreign currency, and we only have dollars in U.S. currency at this point in time. So we're going to have to make an exchange, taking some of our money in cash, exchanging it for the foreign currency at this point. So if we do that today, as of the same day that the end of the contract happened, we can use today's spot rate to do that. So I'm going to say then that cash is going to go down. We're going to decrease the cash. And then we're going to be picking up the foreign currency, which we can record basically as another kind of asset on the books. So we're going to say the amount then is going to be equal to, we're going to get 5,000 pesos, which we're going to value according to the current exchange rate, which we're saying is the 0.77. So there's what we're going to have here. So we're going to then say cash is going to be decreased, and we're actually going to decrease physical units of cash of 3,850, and we're going to receive actually 5,000 units of the foreign currency, but represented in the current US dollar equivalent amount, 3,850. So now we've got our currency in foreign currency units, 3,850, representing 5,000 actual units in the bank that we can use to pay off the payable, which also is valued at 3,850, but which we promised to pay not in dollars but in pesos, and they're both valued using the same exchange rate, which is today's exchange rate at this point in time. So then, of course, we can simply pay off the payable now that we have the money to do so. So I can say, okay, then the payable is going to be debited for the amount we're going to pay off, and we're going to be paying it with these units now that we have in foreign currency. And the amount then is going to be the same. The amount's going to be the 5,000 pesos that we're actually paying, valued at the current spot rate, 0.770 or 3,850. So then we're going to go ahead and calculate this out. We're going to say then that, or post it out. I'm going to double click on this item, something's in it, say plus. We're going to hit the 3,850, bringing it then down to 0. And then the foreign currency units up top, double clicking on that item, going to the end of it, plus. And then I'm going to take that down to 0. So that has now been decreased down to 0. We're only left with the receivable to remove off the books. And this is the other side of the contract. We're going to receive the 3,700. It simply will be in cash. This 3,700 has not changed since we originally put it on the books up top, because the receivable side was in cash. The speculative side was on the payable. So this one's going to be a straightforward receivable kind of transaction. We're going to get money now. So we're going to say cash is going to be going up, and just simply US dollars. So therefore just simply cash for us. And then the receivable is going to be going down. And once again, it's just in US dollars as well. So that's simply going to be for the amount we originally put it on the books for. I'm going to pull it up top so you can see that it hasn't changed since that original journal entry. And that's the debit and credit. And then I'm just going to double click on the cash and say plus. We'll pick up that 3,700, and then we're going to go on down to the receivable here and say this is going to be equal, and we'll pick up that 3,700 there. So at the end of the day, this is where we stand, the receivable and payable off the books at this point. We have a $50 gain down here, but we had a $200 loss up top. So our speculation, once again, didn't turn out too well. We're not very good at this, apparently. We kind of lost in both of our speculations, but that's okay. We had the loss of the 150 total, and we needed to break out the loss on the 200 in the first year and then the 50 in the second year. When we put this into QuickBooks now, we have to basically consider that same kind of component. So notice we revalued this item in order, we revalued the payable in order to do the journal entry in like a two-step process to record the journal entry. When we go into QuickBooks, we'll do it a little bit differently in that we will reverse the $200 adjusting entry, and then we'll let the system record the full difference, which will be the full difference of the 150, and the fact that we put an adjusting entry and the reversing entry will mean that we'll work everything out so that there will be a $200 loss in year one and a $50 gain in year two. So it'll look a little bit different, a little bit of a twist on it in the QuickBooks system, but it's a standard kind of adjusting and reversing entry process, which logistically works well with accounting software. It works well with accounting software. So we'll look into that next time.